We are taking a look at some unusual tax deductions you might not know about, because now is the time to start thinking about write-offs to bring down the amount you owe the IRS. For more on that, we are turning to Jim Uren, the CFP with Phase 3 Advisory Services. And what are some unusual tax deductions, starting with real estate?
Sure. Yeah, as you mentioned, Angela, there's a lot of tax deductions out there, but they're hard to find because the tax code is just so long. But one of the unusual tax deductions for homeowners is what we call the 2-week tax-free rental income rule. Now, under the IRS rules, if you rent out your primary residence for 2 weeks or less each year, you may not have to pay any income tax on that rental income, regardless of the amount. So, for example, let's say you live near a location of a big annual sporting event or festival or conference. You might have a week or two where you could earn, let's say, $5,000 or more by renting out your home. Now, if you rent out your home for 14 days or less, you will likely not be charged any income taxes on that income. Now, of course, before you take advantage of this tax break or any others, it's important to discuss this with your tax advisor, because these IRS rules are often very complicated, and making one mistake can often jeopardize your tax savings.
What about stock investments?
Well, another unusual tax deduction that not a lot of people, or even some CPAs, are aware of for that matter, is something that's called the Net Unrealized Appreciation Rule, or NUA. Now, this is a tax break that may be available to you if you own any employer stock inside of your work-based retirement plan, like your 401k. Now, as your listeners may know and viewers may know, typically when you make your withdrawals from a 401k, those withdrawals are subject to ordinary income tax. However, using the net unrealized appreciation rule, you may be able to withdraw your employer stock in the form of shares rather than in the form of dollars. Now, in this scenario, you would only have to pay ordinary income tax on the amount you originally paid for those shares, and not on the total value of those shares you receive. Now, then when you go to sell those shares at a later date, you would only have to pay a long-term capital gain tax on that increased value. And because, of course, capital gain rates are often substantially lower than ordinary income tax rates, this strategy could save you thousands of dollars on your 401k withdrawals. But you do need to be careful, again, because the IRS has very particular rules on what needs to happen if you want to take advantage of this NUA. And it's important to work with someone who understands the process so you can get it right.
If someone owns a business, what's an unusual tax deduction?
Sure. One of the more unusual, and it's unusual really more because it's new. So not a lot of people are aware of this yet, and it applies to certain businesses in certain states around the country. So since about 2017, the IRS limits the amount of state and local taxes that you can deduct on your tax return to no more than $10,000. However, a variety of states have passed laws that provide a workaround to some of their small business owners in those states. Now, these laws are typically called state pass-through entity taxes. Now, the specifics can vary by state, but these laws allow business owners to pay personal state taxes through their business and claim that payment as a full business deduction. Now, doing so then allows the business owner to get a full deduction for their state and local income taxes, even if they exceed that $10,000 limit. So if you do own a business, check with your tax preparer to see if you qualify and what you need to do in order to take advantage of this unusual but potentially profitable tax deduction.
Thank you for your tips today.
Thank you.
Go to businessfirstam.com for where to see our show on TV.